Hathaway's earnings is a quarterly big deal in the stock market. Earnings season is always the highlight of a given quarter, but Berkshire's earnings are a bigger deal because it's Warren Buffett's company, and Warren Buffett is the greatest investor of all time in most people's view, and because Berkshire Hathaway has businesses across the economy, and so we can learn a lot from its performance every quarter about what's happening in the broader economy. Q4 and Q1 earnings in February and May, respectively, are bigger deals among the four earnings reports for a couple reasons. In May, Berkshire Hathaway has its annual shareholder meeting, the so-called Woodstock of capitalism, where everybody goes to Omaha to hear Warren Buffett and his lieutenants answer questions in an arena and just have a great time connected to investing, value investing, and everything Berkshire Hathaway. Q4, which is what we're talking about now, is when Warren Buffett releases his annual shareholder letter, which is always closely read by investors around the world. I'm going to do a close read of that letter now to share some takeaways and some thoughts on what Warren had to say about the last year in the economy, in Berkshire Hathaway, and beyond. I previously did a video on the results themselves, so you can check that out here. You can subscribe to this channel for the long and short of the markets, which is what I am producing now. My name is Daniel. I will have a written version of this on middlecoastinvesting.com on the blog there, so you can check that out there. And before I get into the actual breakdown, I just want to say I'm not a Buffettologist. I'm not an expert on all things Warren Buffett. I've followed his career relatively closely since I got into investing more than a decade ago. Read a biography about him. I would say I'm versed in Buffett without being able to cite things super specifically. I admire his investing and business career. It is one of the greatest that we will ever see. I think he's a human like the rest of us. He will make mistakes as much as any of us do. I don't think he is saintly in any way, just a guy trying to do his best. And if I criticize here, I'm not trying to criticize the person, just comments he made, just trying to put them into a further context. With that all said, let's go into the letter and point out some of the big things. Charlie Munger, Warren Buffett's longtime right-hand man, as well as mentor in some ways, died last November at the age of 99, just shy of his 100th birthday. It's no surprise then that this year's shareholder letter begins with Warren Buffett's one-page tribute to Charlie Munger, though the font choice is a little bit surprising. Charlie was the architect for what we did at Berkshire Hathaway, Buffett says in so many words, which is mostly based on Charlie Munger's insistence that Berkshire Hathaway had to start investing in wonderful businesses at fair prices rather than fair businesses at wonderful prices, the school of investing that Warren Buffett learned from his mentor previously, Benjamin Graham. Buffett's realization that Munger was right and that this was a necessary shift was what he says makes Berkshire Hathaway what it is, especially given the size of the company. It's the old dichotomy in investing of investing in quality versus investing in value. While Buffett has always epitomized this shift as he started out in value and then went over to quality, he's giving the credit here to Munger as being the driving force. Not a surprise, as Munger has talked about this over the years, but nice to see Warren attributing this major shift in his career to his old friend. Warren suggests that Charlie was humbly willing to stay in the background and let Warren get most of the accolades, while he just helped run the business from his perspective and helped guide Warren. Humility on both sides to some degree, though I would argue both of them enjoyed the spotlight. Charlie especially found the spotlight in the last 20 years or so of his life. But all that said, it's nice, a positive note for Warren Buffett to begin this letter, and there was really no other way. We knew that it was going to be here, but nice to see it all the same. Buffett starts the actual shareholder letter the way that any writer should start, though usually they start in their own head rather than on the page, thinking about who his audience is. Buffett says in the end his audience are his shareholders, and he uses his sister Bertie as the stand-in for that shareholder audience. Bertie has been a longtime shareholder of Berkshire Hathaway, has become quite rich from her holdings in the company. She is smart, takes no nonsense, doesn't know everything there is to know about accounting or investing, but just wants to hear how things are going and just the facts, ma'am. That's who Buffett says he's writing to, which is fine, though I think it's always worth noting that he knows and we know that he has a bigger audience than that in mind. He knows and we know that everybody cares about Warren Buffett's annual letter in the investing world and in financial media, and that this is going to get read widely and farly, even from people not owning shares in the company. So that's one point to make. And Warren Buffett is always, he's more politically savvy than he likes to admit. Warren Buffett is not the biggest player in the world, and he's 93, is in his later years for sure. But he's trying to make points when he writes in these letters. Some of them are hobby horses, like his recent, again repeated hobby horse about how silly it is to include unrealized gains in GAAP earnings. He brings that up again here. And some are more pointed. Last year, he talked about the importance of share buybacks, trying to fend off any concerns that we should add taxes onto share buybacks. He thought that would be silly, even though he didn't say it in so many words. And in this letter, too, there are a couple times where he's trying to make a political point within the context of explaining how things are going at Berkshire Hathaway, which is inevitable given his importance and prominence in U.S. politics and economy, and how big Berkshire Hathaway is. Its business is going to hit on political challenges one way or the other. Buffett then makes a little bit of a victory lap combined with a little bit of a lament. Berkshire Hathaway's net worth, or book value, is 6% of the S&P 500's entire net worth, which is impressive on the one hand, but means it'll be hard, Buffett says, for the business to double in the next 5 years, for example. This is the reality of owning Berkshire Hathaway shares, as I do, for example. You can't expect major outperformance. It's just unlikely at a business of this size and this diverse nature. Berkshire Hathaway is not going to benefit from one specific dynamic. It has so many things going on that, on the one hand, you don't have the risk of losing all your money because there's so many different businesses here. But on the other hand, you are unlikely to have a huge gain. Berkshire Hathaway should do a bit better than the average corporation, Buffett says. The thing is, if you do a bit better than the average corporation without the risk of a major loss, over long terms, that can compound into serious wins. Now, I should say that it all depends on what your starting point is. If you look at the last 5 or 10 years, Jan 1 to December 31st, Berkshire Hathaway is trailing the S&P 500 in both of those periods. You change that start and end date to February 25th or 24th, and Berkshire Hathaway is actually outperforming in both. So again, starting dates matter. But over time, there's also a feeling of security and confidence in knowing that if your money isn't at risk of permanent loss, it's easier to just trust your money in that vehicle to invest in those shares with the possibility and maybe even expectation of outperforming over time, but also with the assurance that there's no major risk on the downside, even as compared to investing in an index fund. That's, for example, why I invest, not a major position, but I do invest in Berkshire Hathaway shares. I think of it as an index fund, but better. That's the reality of Berkshire shares right now, and it's clear that Buffett is aware of that to some degree. Buffett then talks about some of Berkshire Hathaway's investments in public company equities, which is always interesting for us as investors. He talks about his investments in 5 major Japanese companies, which is, his point here is an interesting one because Japan is usually considered a not shareholder-friendly jurisdiction. But Buffett argues that actually, in certain important respects, these 5 companies that he's invested in are more shareholder-friendly than U.S. companies. He points out both shareholder returns, meaning dividends, share buybacks, but also that the management team is not excessively compensated. This, I do think, has been a hobby horse for Buffett over the decades, but it's an interesting point to make and contrary to popular wisdom. He then talks about Occidental Petroleum, which is one of Berkshire Hathaway's biggest relative positions, meaning they own a big chunk of this company while it's still public. Over over 27% of the business, in fact, which is a huge number. And Berkshire Hathaway has the option to actually increase that at a relatively low price and has been regularly buying shares over time. What's interesting about this is a couple things. I mentioned politics, and Berkshire Hathaway, Buffett makes a staunch argument for the value of domestic oil and the freedom it gives us to not depend on foreign oil sources. It's important for us, I believe, to wean ourselves off of fossil fuels. It's also the reality that we do need them in the current time, and we do use fossil fuels for a lot of what we do. And so, within that context, that's the political point that Buffett's making, the importance of that oil. But then he says we don't want to actually buy the whole company, which would be the logical endpoint to what he's doing. Buffett is super praising of Occidental's management, of their CEO, Vicky Holub. He believes that she does a great job, that Occidental is a great business, but he says we don't want to buy them. We don't want to manage that business, which is curious because Buffett and Berkshire Hathaway are famously hands-off owners of their businesses. The main office in Omaha has very few employees relative to the size of the overall business, and it's meant to basically funnel capital, funnel money to the different businesses as they need it, but not to really be hands-on. So it's not as if they would be managing that business very closely. It's something to watch because it doesn't quite add up why he wouldn't want to own that business, unless it is that political blowback from Berkshire Hathaway owning an oil company. So we'll see. One other thing he talks about is Coke and American Express, businesses that he loves to talk about that he's owned since at least the 90s, owned American Express some years before that as well, and that he hasn't changed the position for Berkshire Hathaway in 20 years, I believe he says. He talks about how much he likes these businesses, how solid, how long lasting they are, and how they are continuing to pay bigger and bigger dividends, which will just come back to Berkshire Hathaway, and what a boon that is to the company. It's curious to me because I don't think those businesses have actually outperformed all that much since Berkshire bought them in the 90s. I looked up the numbers last year and couldn't really find great outperformance. But maybe this again goes back to our point about Berkshire Hathaway earlier. There is value in finding investments that you trust to do well over time and you trust will not burn you. You have a few of those, and even if they don't outperform that greatly, it allows you to then invest in other higher upside businesses. Maybe that's the logic here. I also found this interesting for one other position that Berkshire Hathaway has in its portfolio, Capital One. Capital One just last week announced that it has a deal to buy Discover Financial, a stock that I own. This is interesting because if this deal goes through, and there's going to be some regulatory scrutiny of this for sure, Capital One will be a strong competitor to American Express because it'll be both a lender and have a payments network the way that American Express does, meaning a way to accept credit card payments. You have MasterCard, Visa, and then you have Amex, and then Discover. Capital One, which is a stronger and arguably better run business, will be able to take that and then be really not necessarily on par with Amex, but a real competitor to that. I, for one, would welcome Warren as a fellow shareholder in the combined Capital One Discover Financial business if that comes to pass. But I'll be curious to see if he has anything to say about this, either from the Amex perspective or from the Capital One Discover perspective over the next year and beyond. Buffett is not a sugarcoater in these letters, and I don't want to take anything away from him on that front. He tells it like it is. And in this case, he talks about the disappointments that were Berkshire Hathaway's railroads and utilities businesses last year. Those are the biggest disappointments, whereas insurance was the big winner. But I do think he's kind of pointing the finger elsewhere when he explains why these businesses didn't do as well as he'd like. Railroads means Burlington Northern Santa Fe, and Buffett's commentary is a bit two-sided. On the one hand, this business costs so much to run, you have to continually replace railroads, you have to continually invest, and so our returns don't look as good as they are. On the other hand, it would be so hard to replace this business by a competitor. We feel really confident that nobody can compete with this business starting from scratch. That's why we were able to buy it at a reasonable price, way lower than the replacement value, and so on. He says that the returns have been acceptable but not great, And he does some passive aggressive grumbling about how Washington interfered with negotiations with the unions over wages and compensation, implying that that's why the business didn't do so great last year. When you look at it, as I said in my other video, it seems like it was more an issue of losing out to some competition for a certain line of the business. And wages and compensation did rise, but not dramatically, not drastically, not in a way that I think really torpedoed the business. It's curious that Buffett is making this political point and trying to argue that it's not really our fault about the railroads. And for it not being a great business, if I got the math right, it's returned $51.7 billion to Berkshire Hathaway since the purchase in 2010 for about $34 billion, though that purchase price involved stock, so that purchase price has actually risen considerably since then. We'll set that aside for now. Seems like Berkshire Hathaway is a proud and should be proud owner of Burlington Northern Santa Fe. Seems a little bit sour grapes. But Buffett then also complains about utilities, and I think whether or not he's pointing the finger at the right cause, his points are at least more justified or more understandable, the crankiness. He says that governments have started to go back on the compact between utility businesses and governments of utility business being able to earn a fair return on their business as long as they did the business well, sometimes with an upside kicker. Utilities, we're talking about electric, natural gas, and heating, these sorts of businesses that are essential that we have that are often closely regulated as a result because governments don't want businesses to screw around in providing basic services to their citizens. That's sort of the construct here. Buffett, I think, is grumbling. He points out California and Hawaii as places where you just can't make money in the utilities business. And he kind of, by the side door, mentions what the actual causes probably are. I'm no expert here, but my sense. Points out increase in forest fires and climate change making the environment more difficult, literally, figuratively. At that point, I'm not sure who's going to make out right. I don't know the details. Business people will always say that the government is at fault. Government will point their finger at greedy business. I don't actually know the details here. I'm not well versed. I can understand Buffett's crankiness about this business. It's tough business. No way I would invest in it if it wasn't through the Berkshire vehicle, but I'm not sure what there is to do about this. This to me seems like a little bit of political point scoring rather than an honest accounting of what is going wrong and how it might be solved. Not trying to be unfair, but that's how I read this section as a whole. The letter ends with wonderings over the magic of Omaha, where Buffett is from, where Munger was born, where Ajit Jain spent a few years back in the 80s or 90s, and where Greg Abel spent 6 years in the 90s. Ajit Jain is the runner of Berkshire Hathaway's insurance business. Greg Abel, Buffett says, I think for the first time in a letter, though of course it's been said publicly at his shareholder meetings and otherwise, is ready to step in as CEO tomorrow as need be. This is an interesting mirroring of where the letter begins, or the pre-letter, the one-page tribute to Charlie Munger. By talking about Jain and Abel, and he talks about Jain earlier in the letter and says how great Jain is, and talks about the Hall of Fame quality business managers that Berkshire has, and talking about how the business is not going to double anytime soon, how it's inevitably going to do a little bit better than the average corporation, but not greatly better. And in talking about his successor as CEO, at least the one that we all know about, Greg Abel, and the person in charge of insurance, the most important business at Berkshire Hathaway, Buffett is talking about the future when he's not here. He's 93. His longtime colleague, Charlie Munger, has just died. We all know that the road is not going to be so long for Buffett. And so he's thinking about the future in a, I think, more direct way than he has in the past. Not that he's shied away from the topic, but a more direct way than in the past in these letters. And it's an interesting note to end on. It's inevitable. It's one that we've all talked about or thought about as Berkshire shareholders and as people in our own lives. And it's at the same time at least a little bit jarring to read about and think about if you're holding shares in the company. But that's where we end that letter. And that's where I'm ending my review of the letter, which, as always, I think is a fascinating read, not a very long read and not a difficult read. If you haven't checked it out for yourself, just go to berkshirehathaway.com and you'll find a link to shareholder letters for 2023 and past years. I have on my back desk somewhere, Lawrence Cunningham has compiled letters into themes over time. That's a worthwhile read as well. But we can always learn from this. We've all learned a lot from Buffett and Munger over the years, and may we get to read these letters and learn for many more years ahead from the Oracle of Omaha. That is the long and short of the markets for today. Check out the written version of this on middlecoastinvesting.com/blog. You can find that on my website. Subscribe to this channel to get more of these videos. If there's anything else you saw in the letter that you like to note, mention in a comment. Thank you so much for watching, and I hope to see you next time.